Hello, everybody. Welcome to Zoe's Treasures. My name's Tracy. I am here with my husband. He is in the background doing our graphics. Hello, Kim. Hi, everybody. Welcome to Friday night. Good afternoon, the Dazzle Depot. We are doing Ask a CPA any tax questions you have tonight. So, hello, lady. I can never pronounce your name right. We're going to call you lady. Hello. Thank you. The name, I've seen your name before. It looks very familiar. I just can't say it right. Welcome in, everybody. So tonight is just about tax questions. I'm going to talk about the home office, just in case, I always prepare some notes in case there aren't a lot of questions, but we are in the thick of it right now. We are in the end of March. April 15th is just a couple of weeks away, about 3 weeks away. So I know everybody is right in the thick of trying to wrap up their taxes and get those done so that we're not waiting until the 14th. So if you have questions, it could be about your taxes. It could be about anything. Maybe your accountant, if you use one, or a CPA said something, you're like, I don't really understand what they were saying. And maybe you have a question on that. So anything you have, please feel free to put in the chat. It is free shipping tonight. I do have stuff in the bin that I normally would have on my chat shows. So our PDFs and our books are available in the bin if that is something you're interested in. Other than that, let's start talking about the home office, and I will keep my eye on the chat to answer any questions as I see them come in. Hello, Rainy D. Now let me take a drink and we'll get started. So the home office, throw an emoji in the chat if this is your first year filing taxes for your business. If you started your business in 2025 and this is your first year. It'll give me an idea on how many people have done this before and how many people haven't. So we have one first timer. The rest of you have been there. Have you used the home office deduction before? Is that something that you're familiar with? Most people have heard about it because it's a really great deduction, a really good way to save some money on your taxes. So one of the things I always say, you'll hear me say this on almost every tax show, you have your book income, you have your accounting, and we want our accounting to be really high, right? We want to show a really, really high net profit because we want to know that we're making money and doing good. But then we have our taxable income. We want our taxable income, our net profit on tax, to be really, really low. Well, one of the ways that we get that difference is by some of these deductions, like the home office or the mileage deduction. So last week we talked about the vehicle expense and the mileage. So that was one of them. So we'll talk a little bit about home office. There's two different ways to take it. What do you need to do? How do you claim it? Where do you put it? All that good stuff. I do want to say, if you are new to me, this will be your first year. Okay, great. So this will be great information for you. If you are new to me, you do not have to buy anything. Hello, Jules. You can watch all of these shows on YouTube again. So don't feel like you need to buy something to rewatch. If you miss something, you can always go back to YouTube to rewatch at any time. So let's pull up the Schedule C. Let's look and even see what we're talking about here. We'll get it. Almost. Just a second. It's coming. So on your Schedule C, and most of what I'm going to tell you, I am talking to sole proprietors and single member LLCs. If you are a multi-member LLC, an S Corp, or corporation, the Schedule C doesn't apply to you. But the Schedule C applies to probably a good 95% of those of us on Whatnot. So this is what I'm focusing on when I'm doing these talks. So this is your Schedule C. I know it's a little small, but we're going to zoom in. And okay, let me get rid of this so you can actually see. All right, we're going to zoom in so you can actually see what we're talking about. We want to go down and look at line 30. So in previous weeks, if you had not come here before on a Friday night, in previous weeks, we've talked about the beginning of your Schedule C, the revenue, the expenses. We talked about the vehicle expense last week. So now we are down to line 30. And line 30 says expenses for business use of your home. It says do not report these expenses elsewhere. Attach Form 8829 unless you're using the simplified method. All right, so line 30 is where we're going to use the simplified method. There's two different methods. I'm going to detail what those methods are for you and kind of how to figure out which one you should or shouldn't be using. And this is where that expense would go. So let's talk about it. You can go ahead and take that down. I just wanted to show where that was. So like we said, there's two methods. There's the actual method, and then there's the simplified method. Let's go over the simplified first, because as the name implies, it is simpler, has a more very quick and easy kind of way to understand it. First of all, though, before we jump into either of these methods, there's a few rules that apply no matter which way you go with this. So some of those rules are, you can take either one of these, actual or simplified. So the home office is available if you own or if you rent. And that includes renting anything that's considered a livable structure. So it could be an apartment, a house, a townhouse, a boat, an RV, anything that's a livable structure that you are actually using as a home and that you have a home office in. The other key thing for this home office is the IRS says it has to be used exclusively for business, used regularly and exclusively for your business. So you have to have an area. Hello, D. Lewis. You have to have an area in your home that is your primary, exclusive, and regularly used for business. So what does this mean? It means that if you decide to set up your tripod on your dining room table and you have some stuff here in front of you and you're doing this at your dining room table and doing a show, but then you clear it all off and your family comes and sits down and eats dinner there, your kids do homework there, that's not used exclusively and primarily for your business. That wouldn't qualify, that space. But if you have a corner of your dining room, and it doesn't have to be a complete blocked off room. It could just be a corner of a room where maybe you have a desk or a table set up, and that's where you do your whatnot shows. The square footage that you use exclusively and regularly for business is what we can consider our home office deduction. That's what we can use for our home office. So again, it doesn't have to have four walls. It doesn't have to have a curtain. You just have to be able to distinguish that space as being regularly used in your course of business. It has to be your principal place of business. So what does this mean? For whatnot, this is a really easy requirement for us to meet. I'll use myself as an example. For my whatnot business, my principal place of business is here in my home. It's in my basement. I do everything right here for whatnot. So I can deduct this area here. I conduct all my business for whatnot here. Now, does that mean 100% of your business? No, it means the majority of your business. If I want to go lay in my bed and work and set up shows on my computer, that's okay. I can still count my studio area as my primary place of business. I want to say one exception. When I said exclusively used for business, there is one exception to that, and that is for inventory areas. So again, I'll use myself as an example. I have a little studio here. It's about, 10 by 10 feet studio. This is what I use. No, my husband's saying no, it's about 10 by 10. About that. This is my primary use. So I will take, that's 100 square feet right now. I also have space that I use for inventory storage. Now, in my case, it is used exclusively for inventory. That's all I use another space for. So I can also take the square footage of that and add it to my studio. But what if your inventory is also kept in a bedroom or kept in a hallway or kept in your living room? Maybe you have bookcases in your living room because you don't have a lot of extra space, and those bookcases house all of your inventory. Or maybe you sell clothes and you have tubs kind of stacked up along the hallway or in a spare bedroom somewhere. So if you have a space where you're maintaining inventory, but it's not exclusively used, you can still count it for inventory. So, so keep this in mind. You have your selling area, but then you have a spot that's not exclusive, but you store inventory. You can still count that for the inventory. So the exclusive only applies to the part that you are actually performing your business. You get a little bit of a break when it comes to where you're storing your products at. Okay. Now, the one thing with the products, with storing that inventory in order to not be exclusive, is that your home has to be your only business location. We're going to talk about that. For most of us, it's okay that our home is our only business location. So those are the main rules that apply to both. So let's talk about our simplified method. Once you can determine what is your exclusive use, what do you use exclusively and regularly, you get that square footage. You take the length, multiply it by the width, you get your square footage, right? Super easy to come up with. The simplified method is the IRS says, hey, I'm going to make this super easy for you. I'm not going to make you calculate a bunch of stuff. We just need to know the square footage. They allow you up to 300 square feet. So if you have 310 square feet, you get 300. If you have 299 square feet, you get 299. So up to 300 square feet. What it does is reduces the administrative burden. It reduces the burden on you on all the record keeping, which you're going to hear about when we talk about actual in a minute. And then they say, so up to 300 square feet, you can just deduct. We're not going to make you jump through hoops for it. And we're going to give you $5 per square foot. So let's just say you're right there at that 300 mark. You have 300 square feet. 300 times 5 is a $1,500 deduction instantly. You don't need to do anything else. All you need to do is document that you have at least 300 square feet. That's what you get. That's the simplified method. When we just looked at the Schedule C, that was line 30. You just write it, you fill it in right there. Now, the line 30 said, if you're not doing simplified, if you don't want to take the easy way out and you want to go with actual, now you need to fill out a form 8829. You don't need to memorize that. That's right there on your Schedule C. But they do make you go and fill out another form. So this one, the actual expense, sometimes can give you a bigger deduction than $1,500 in the simplified. Because the actual expense, you're going to do the same thing. You're going to figure out the square footage. That doesn't change. That applies to both methods. But then you're going to be able to take all the actual expenses that apply to that portion of the home. And I made a list of the ones that they actually talk about in the IRS publication. Painting or repairs. So this is my studio. I painted this, well, you see a green screen behind me, but behind that is a wall that is blue. I could deduct that paint if I'm doing actual. So the cost of the paint, the cost of repairs. If something breaks, you have to fix the floor, or there's a hole in the wall and you got to fix the hole in the wall, or whatever it may be. You got to fix a light fixture. So repairs, that can be part of your actual. The part of the insurance for your home. Any homeowner and a lot of renters have some type of insurance for their home. So if you calculate your square footage and you're like, hey, my square footage equals 10% of the total footage of your house, 10% of the insurance you pay for your home or your rental insurance could go into your actual expenses. Utilities. If the utility affects the area that's used for your home office. So what's generally affects the area used for your home office? Electric. If you have gas heat, that would. Water, sometimes. If there is a bathroom that is part of your area, you could probably get away with deducting some water. That's kind of a tricky one. That would be more like maybe you have a spare bedroom with an ensuite that you totally use for business. I could see that being applicable. You got to keep in mind that the IRS has a lot of gray. For as many rules as they have, there's a lot of ways to interpret those rules and to kind of massage them one way or the other. So this is one of those areas on whether you would include water or not. But definitely electric, gas, internet. If you know, I'm sorry, I got sidetracked. I'm going to answer this question. I never got approval for home deduction because 50% is at a separate office. I don't know. I see clients virtually and do my ad work in my office at home. But 50% is at a separate office. So I'm guessing, and maybe you can clarify, that you actually have another location you do work at. Yes, that's why. Because that means one of the first rules we said is that in order to qualify for the home office deduction, it has to be your principal place of business. So that where you're conducting the majority of your business, the principal place of business. So what does this mean? Like in your case, if you're doing most of your work, you're actually at another location, your home office isn't your principal place of business then. This would also apply, let's look at this from a reselling perspective. If you have a booth somewhere and in that mall, maybe you're buddies with the owner or something, and they allow you to do most of your work there, and your work at home is like a byproduct, is that where you have your booth? And if you have office space there to use, that may be considered your principal place of business, therefore disqualifying you from the home office. Now let's look at it in the opposite way. If I just have a booth, all I do is rent. I do not do any of my administrative management duties. I don't do any of that. I purely just have a booth space that I restock, make pretty, and go home. I'm not doing the majority of my business there. In a case like that, my home office would qualify because my home office then is my principal place of business. So I go back to, it's a lot of gray, and you really have to kind of think through all of the logistics of it. So I can take the percent of services then from my home space. Just want to make sure I'm not missing money. I think that's what you were saying. Not, Jennifer, not if your other office is your primary place of business. If your other office is your primary place of business, then you would be ineligible to take the home office. So you have to figure out that in your case, it really sounds like it rests on the fact of where is the principal or the primary place of business. Okay, cool. Some other things that we can take. I know they're pretty picky about this home office because it's one of those things that in the past was very abused, very misused. And there was a reputation at one point that using a home office deduction was a red flag for audits. And at one point in time, that was true way, way back. That's kind of a myth now. Like now it's not so prevalent, particularly because they came out with the simplified version. And so a lot of people elect the simplified version. Because look at this, we're talking about the actual and we're like already down 4 or 5 things. It's not just knowing I had utilities. It's not just knowing I paid the insurance, but it's keeping up with all of that documentation, all of the justification of that. There's a lot more administrative work. It could, at the end of the day, result in a lot bigger of a deduction, but it's more work to get that deduction. There's always a trade-off or something, right? We talked about general repairs, and again, it's only the business percent use. Real estate taxes. So you get a portion of your real estate taxes in proportionate to the percent that you're using for business. If my office is used for my regular job 3 days a week, and I used whatnot also on the other days, can you qualify? You can, but what you're going to have to do if you're only using it 3 days a week is you're going to so let's just say that home office, and I'm just going to make some assumptions here, that you have like a spare bedroom that's been turned into a home office. You work a 9-to-5 job, and 3 days a week you're in there working remotely in that home office. The other days, 4 days a week, you're using it for whatnot. Because you're using it for another use, the whole 10% of that or whatever. Yes. Okay. So let's just assume that it's 10% of your square footage just to keep numbers simple. You can't just take a 10%. You now take that 10% and you need to figure out what are the days are. So take that full 10%, calculate it out, and then say, okay, if it's 10%, but I only used it, what is that? 50%, 60% of the time for whatnot, then you're going to have to add all of that up and take 60% of the deduction. You have to be up and up and on, and say, no, I didn't use it 100%. You can use it for those days that it is considered whatnot. But you can't take the full deduction. So you're going to have to reduce your deduction in order to do that. Some of the other things for the actual expenses, we talked about real estate taxes. Now keep in mind, real estate taxes is also something you can deduct on your personal tax return, right? So the portion you deduct, if you're using actual, the portion you deduct on your Schedule C cannot also be deducted on your Schedule A for personal. You're going to have to back some of that out, okay? You can't double dip. You can't take it in 2 spots. Mortgage interest, so the interest, and that can add up pretty quickly. Casualty and theft, this thankfully is not something that happens a lot, but if you had any type of casualty or theft that happened, that affected that area of your home. Depreciation, this is a big one. We talked about depreciation a few weeks back. If you're not familiar with the concept, basically it means if you own a piece of equipment or property like a home or a warehouse or something like that, you normally don't get just to expense all of that. You take a little piece of it every year for the life of that asset, okay? So your home is an asset. If you're using actual, you can take some of the depreciation as part of your actual expense. Now, there's a ton of rules around this, and there's charts in the IRS publications. So I'm not going to go like super deep into it, just more so to let you know that this is one of the expenses that you can apply when you're using actual. There is also security systems. If you have a security system in your house and you have to pay for it, if you're using like a Blink or whatever, any of these security systems that you may need to pay for, then you can also take a piece of that. So as you can see, with the actual, there's a whole lot more expenses that you could take. However, there's a whole lot more work that goes into calculating all this, keeping track of it, documenting it, just in case you're ever questioned by the IRS. But those are the two methods. I do want to bring up a chart. The IRS has a really good flow chart that I want to show you guys, but let me see if my husband can get it. Honey, I emailed you a chart earlier today. Is there any way for you to pull up your email and see that chart? I took a screenshot and emailed it to you. I know I'm totally putting him on the spot here. He was not prepared for this. I didn't tell him I wanted to show this. I emailed and then forgot to tell him to have it ready. We'll see. We'll kind of hold off. If he can get it, we'll show it. One of the things I want to say about this, Whatnot gives a 1099 to every seller. Olga, great question. Only the sellers, only if you met the threshold. So Whatnot is required to send you a 1099 or make available to you a 1099 if you had $20,000 in sales and 200 transactions. If you met both of those requirements on Whatnot, then they are required to furnish that 1099 to you. If you didn't hit that threshold, they don't have to send you one, but you still have to claim the income. So if they didn't send you one, if you didn't hit that threshold, one of the things you can do, and this is a question I've been asked a lot, is you can go to your finance section on your Seller Hub. So open up your computers, go to your Seller Hub. There is a financial section. And then when you're in the finance section, it's like the third tab. There's like statements and reports, I think it's what it's called. And there you can get a weekly, monthly, or annual report. So you can pull an annual report and use that to match up to your own personal records to make sure everything is on the up and up for taxes and what you need to do. And that you didn't miss anything or whatnot, doesn't have too much, whatever it may be. One thing I do want to say, you didn't get it? Okay, we'll skip it. There is a really good flow chart. I'll try to find it to show it sometime. When you are trying to decide, do I want to take actual or do I want to take the simplify? Do sellers have to pay sales tax? Great question. I'll answer that in just 1 second, Moon Blooms. You can pick which one. And when you pick one, you don't have to stick with it. So for 2025 taxes, you may say, you know what, this is my first year. I don't want to mess with all this other stuff. I'm going to take the simplified method. And then next year, when you go to do 2026 taxes, you can say, you know what? I've got my footing underneath me. I've kept really good records. I want to explore what the actual looks like. So then you can pick actual next year. It is okay from year to year to go from one to the other. So that's a really important point, because one may produce more of a tax savings for you than the other. So Moonblooms, do sellers have to pay sales tax? Yes and no. Every time we sell something on Whatnot, sales tax is included. So our buyers pay sales tax, which then flows through us, and then it's supposed to be remitted to the state, that whatever state it is that you live in. However, most platforms, Whatnot, eBay, Poshmark, Mercari, they handle that for you. So while the answer is technically yes, the sales tax flows through you and then to the state, you as a seller on these platforms don't have to worry about it. Whatnot handles all of that on your behalf. So it's just something that is just one less thing for us to concern ourselves with. Now, if you're a seller on Whatnot, only the Whatnot stuff is going to be handled on sales tax. If you're also selling at markets, flea markets, whatever it may be, then it is up to you to make sure that you're collecting and remitting per the rules of your state. So, my husband's like, talk about sales tax exemption. Yes, there is a sales tax exemption. And it could be a really good thing for you. So if you are a reseller, a sales tax exemption, completely different than federal tax. So this is just for your state sales tax. If you are a reseller, you can apply through your state to get a sales tax. It's a reseller certificate, sales tax certificate. An exemption is actually nonprofit. But what it does for you is allows you to purchase your inventory without paying sales tax on it. Ultimately, the end buyer, so you're going to purchase it, you're going to sell it, the end buyer pays that sales tax. It prevents the same item from being taxed over and over and over again. It could save you a lot of money. I don't know about your state, but think about it like this. How much money did you spend in inventory last year? It could be a lot. It could be $10,000, maybe $20,000. So if you spent $10,000 and your state sales tax is 6%, 6% of $10,000 adds up pretty quick, right? That's a pretty significant number. So depending on how much you're spending in inventory, a sales tax exemption certificate, reseller certificate, can really save you some money in the long run when you're purchasing your inventory. And normally that goes through your state. Sometimes there's some other requirements through your state. It's usually not that difficult. 9 times out of 10, most states just have an online process for that. It makes it pretty easy. And you're in Texas. Awesome. Okay, what else are we talking about? Trying to think. Oh, if some of the rules here on home office deduction. Let's just kind of think logically where this is. If we're talking about our Schedule C, we have our income, right? We have all the money we made. Then we take out our cost of goods sold. That's our inventory that we actually sold. And then we take out all the other expenses. Well, purposely, if we go back and look at that Schedule C, the home office deduction is purposely put after the expenses, because the IRS says, do you want to bring that back up? So there you go. It's line 30, but right above that are all of your expenses. And this is done intentionally because what the IRS says is that if you already have a loss, if you already did not make a profit, you can't increase your loss by that home office deduction. Thank you for showing that. Where can you find your 1099 from Whatnot? Oh, I didn't go over, but that's a great question. So Whatnot distributed the 1099s through Stripe. So if you were hooked up through the Stripe system, you would just log into Stripe and get your 1099. If you were not hooked up through Stripe, if you got your money through PayPal or something else, you will not get that 1099. They were only distributed through Stripe. And that's a really good question because it was actually a little confusing this year. It took me a little bit of digging around back in January to figure out exactly what Whatnot was doing with these 1099s. You are very welcome. So when you get your 1099, let's just talk about that because I've kind of gone over everything on home office. So if you have questions on home office, let me know, but I've pretty much covered all my notes. When you get your 1099, what you need to do with it, you need to take your 1099 and compare it to your records. Hopefully, everybody has been keeping accounting records all year long. Before you even get that 1099, you should know exactly what your gross income was. Remember, your 1099 is going to be before fees. It is your gross amounts before fees, before any other deductions that Whatnot may have pulled out. So if the way you're doing your accounting is you're only recording what you pull out of Whatnot, that's like net. That's after fees and any shipping expenses you may have paid, any promotions or any other monies that would have gone to Whatnot. Your number will never match that 1099. So that's just kind of something to keep in mind as you're doing your accounting. You should be recording in your accounting records the gross amount, so the total sales, and then backing out your fees, your shipping, promotions, anything else that would have been deducted by Whatnot. How do I get a payout through PayPal, or is it only to your bank account? That's a really good question. Ours goes straight to our bank account. I don't know if they're using Are they using PayPal anymore? They still are? In some cases. Yeah, if anybody else knows, mine goes straight to my bank account. It started with Stripe.
If you have PayPal set up, then what you need to do is you need to go into your PayPal account, and there should be an option for you to transfer into your bank There's two ways to transfer it. One is going to be immediately, which is going to charge you some fees, and then the other one would be if you wait. I think it's like 3 to 5 business days, and that's for free. So, but it's logging into your PayPal account.
There you go. I like it going straight to my bank account. I think that's super convenient. So, any other questions you guys have? I've got some more time to hang out here. If not, I'll just come up and start talking about various things about taxes. One of the things I do want to mention, if you were in my show this morning, Safer Too, yeah, just going straight into your bank, I think it's safer. I want to cut out the middleman as much as possible. I just want what not to go straight to our bank. It doesn't go through PayPal. It doesn't ours go straight to our bank.
It goes straight, but it still goes through Stripe. So Stripe is the middleman in this case. In some cases, some older accounts were able to set it up through PayPal, and so PayPal is the middleman. And if you set it up as automatic, it'll just obey whatever rule you put in place at the time. If it's not set up, then you have to do it manually.
There you go. All right. What else can we talk about? One of the things this morning, I have a show every Friday morning at 7 a.m. that I do business and tax talks. One of the things I was talking about is getting tax advice from people who are not accountants or CPAs. Right now, there is a huge surge of people having tax shows, which is wonderful. I think it's much needed education. It's not, people don't come to Whatnot because they enjoy taxes. They come to Whatnot to sell things that they enjoy selling, right? However, a lot of the shows that are happening are people saying, oh, hey, my accountant told me this, my CPA told me this, and then they're telling you what the accountant or CPA says. Our tax situation is very unique to our facts and circumstances. There are a lot of variables that go into your tax situation. Did you ever go over profit and loss already? I did go over revenue and expenses, but I'm happy to kind of talk about them again. Do you have any specific questions, or you just kind of want in general? Let me know and I can talk about it. So when somebody is saying on their show or in a chat show or in a selling show, hey, my CPA said you can do this, this, and this, that's information that their CPA told them about their unique set of facts and circumstances. It may not match your circumstances. So yeah, thank you so much. It's kind of like a game of telephone. By the time it gets to the general public on Whatnot, the information has been skewed or misinterpreted or misrepresented in some way, shape, or form. And I've heard this multiple times. I've heard just really bad advice. So even everything I tell you, I'm usually going to give you where you can find this information on the IRS website or some publication or something to fact check or to look up for yourself if you want. So always do that. I just always encourage you to either go back to your tax person or your CPA or just go to the website. Almost any question you have can be answered at www.irs.gov. They've actually written a lot of their facts and FAQs to be very conversational, very easy to read and understand, and not in that like tax legal language. So there's a search bar just like any website, and you can put home office and it'll come up with a lot of the same information I just told you about. So just as you're doing that, particularly when it comes to taxes, it's always smart to double check, because a lot of people will pass information on that really applies to them, or it's incorrect. So when we're talking about profit and loss, do you have a preferred list of specific categories to keep track of for your records taxes? I always get overwhelmed with all the possibilities. Absolutely, I do. I actually have a PDF that kind of goes over that. But think about it. What we want to do, here it is. I'm going to give you two answers. The first one is, let's think about what we're tracking. We have accounting. We have your accounting, your bookkeeping records, and then you have taxes. So you kind of have two different purposes going on here. You keep your accounting records, your day-to-day, week after week, month after month, in order to run your business, make good decisions. You really want that to be as simple as possible. You don't want it to be 50, 60 different expense types. It's a lot of administrative work. So, I'm sorry. You want it to be as simple as possible. You want to really be tracking the stuff that matters to you as a business, the stuff that you really want to pay attention to, supplies, shipping, telephone, those type of expenses. But then you come to the tax side and they're going to ask you to break that down a little bit more. So if you're kind of like, I'm not really sure what expenses I should track, probably what you should do is take a Schedule C. Can you pull up that Schedule C again, please? So if we scroll up to the expenses, these are all the expenses here, lines 8 all the way through 27. This gives you a really good idea of what you need to track. So if you're really like, look, I really have no clue, start here. Start with these type of expenses, and this can be your chart of accounts. You can use this list here, and now you know you can use it for accounting, and then it'll roll right into your taxes. Now, since we have the Schedule C up, let's talk about the profit and loss, because that was a question that came in just a little bit ago. So if you scroll up to the top of the Schedule C, we're going to kind of play catch up here. We're going to go back and talk about stuff we've talked about in the last few weeks. The first part of your Schedule C, that's the easy stuff. Name, address, easy, easy, easy. We don't have to worry about that a whole lot. Then you get to income. Oh, good. I hope that makes sense. Yeah, it's probably the most easiest way to think about expenses. So then we get to income. You'll notice that this is gross receipts. This is going to match your 1099. Now, if you got a 1099 from Whatnot, eBay, Macari, you're going to add all of those together and put that number here on your gross receipts. Then the next line is really important. That's a returns and allowances. So anytime that you've had to refund money, you still need to count that gross. It's still part of your gross because the money came into you at one point, then the refund went back out. So you should be showing that refund on line 2. That's something you should be tracking throughout the year. So before you even get to taxes, you should have a really good idea on what was your gross and what were your refunds. You can get this information straight from Whatnot. I go back to what I was saying earlier. Whatnot has weekly, monthly, and annual reports that you can pull in. Hopefully, at a bare minimum, you're pulling that report down every month. They release it on the 4th of every month. So the 4th of April, it'll show everything that happened in March for you. And then you should be recording that in your books. And the returns and allowances is one that you should be recording. Because what you're recording in your books, you want to be able to make sure that it matches your 1099, because that 1099 number is what's going to go on row 1 here. Then we get to our cost of goods sold. This is the cost of goods trips people up a lot. This isn't just inventory. Your cost of goods, COGS, is cost of goods sold. Sold is the key word in that. When you buy inventory, you have dollars. You give somebody your dollars, they give you items to sell. You're just trading dollars for items. They're assets. It's not an expense at that time. They're just assets. They're items sitting on your shelf, no different than dollars sitting in your bank account. When you sell that item, then it becomes an expense. Then it goes on this form right here as cost of goods sold. So that a lot of people think, oh, I can just spend a bunch of money. I bought all this inventory. I can write it all off. It really doesn't become, thank you. It really doesn't become an expense until you sell it. Now with taxes, it's a little bit different. The IRS always has some easy way to do something. And when we're talking cost of goods sold, the IRS says, typically people, it's not an expense until you sell it, like I just talked about. That's called accrual accounting. The IRS says, you know what? We're going to let you write off everything. If you don't want to keep track, if you want to make it easy for small businesses, most of us qualify as a small business. For small businesses, you can just write off all your inventory if you want. So it is an option. You will hear some CPA, some accountants say, we'll take the cash method. We'll go under the small business rules and we'll write off all your inventory. That's not technically wrong for taxes. You can do it. But keep in mind, this is what's going to happen. Say you buy $10,000 of inventory in 2025. Or 2025, you bought $10,000 of inventory. And you want to use the cash method. So you're filing your taxes. You're going to take $10,000 of expense. But what if you didn't really sell it all? What if you only sold 2,000 of it, you had $5,000 profit, right? You still have $8,000 of inventory sitting in your house, sitting on your shelves to sell in 2026. Well, now come 2026, you've sold this inventory, but you've already took the expense in 2025. It could come back and bite you in the butt and cost you more money. So before you just automatically choose to take that cash method, this is a time that you really have an opportunity to do some tax planning, to sit with somebody who can look through and say, what's going to happen next year? What are your goals for next year? Now, if you're in 2025, like you're right now, you did this in 2025 and you're like, I'm done. Man, Whatnot kicked my butt. I had enough in 2025, 2026, forget it. I'm out. The cash method makes perfect sense because you won't be filing another return where you're going to claim that expense. But if you're in 2026 and you're like, man, this is great. I love Whatnot. I'm going to keep growing my business. I'm going to keep doing this. The cash method may end up costing you more next year on your taxes than it saved you this year. And I know it sounds a little complicated. You're like, oh, how do I know this? How do I figure out all these numbers? This is where it pays to go and sit with somebody. It doesn't have to be a CPA. You can actually call a CPA firm. They have like junior associates. They call them like senior associates that maybe are not CPAs yet, but know all of this stuff. They're the ones that are like doing all the work, right? And it could cost a lot less money to sit and talk with one of those people. Also, there's a lot of CPAs that'll give free consultations. So particularly if this is your first year, I highly, highly suggest get a consultation with the CPA. Now, let's keep in mind, we're 3 weeks out from April 15th. If you call a CPA now, they are probably going to be like, I'm sorry, I'm too busy until after April 15th. They're working a lot of hours right now. But where do you report assets? You don't have to report your assets. So believe it or not, you don't have to report your assets. There is a line where you could put it on there. Can you open up Schedule C again? We're going to go back and forth. My husband's like, ugh. Let's go to the page 2 and let's see if they have an asset line. Materials used. Nope. No, they do not. So you do not have to report assets as a sole proprietor. The IRS really doesn't care what your assets are. They don't. You know what the IRS cares about? Thank you, honey. That was good. Do you know what they care about? Your net profit and how much tax that they're going to get from that net profit. That's what they care about. Your assets are for your purposes only. You want to keep track of what your assets are because that's part of your internal, your bookkeeping, your profit and loss, and your balance sheet. So your financial statements in order for you to make really good business decisions. But you don't have to report your assets. They don't care if you have $1 million sitting in the bank. What they care about is the net profit and what you're going to pay them in tax. So I just keep the original receipts to claim for future year expenses when assets become cost of goods. Exactly. Yep. I'll just keep the receipts. That's all you have to do. You just file them away. If you have them electronically, save them by year, and that's all you need to do. Yep. Hopefully that answered your question. And speaking of, since you asked about documentation, we'll talk a little bit about documentation. We keep receipts just in case we're audited, right? You get a receipt, it comes in, you do your business, you got your tax return. You should be recording that on a daily, weekly basis. Thank you so much. Stay home to shop. You should be recording that on a daily, weekly, whatever basis in your own records. And then you file those receipts away, or if they're electronically, put them in a little folder, create a folder in your Outlook box, or whatever email you use, your Google Mail, whatever, for all your electronic receipts. Your CPA doesn't need your receipts. The IRS doesn't want you to send them receipts. They're only there if you were to get questioned by the IRS on to substantiate some expense. It's the only reason they exist. I don't say that to encourage you to be careless or not to keep them. Definitely keep them. 3 to 7 years, usually around the 5-year mark, you can get rid of them. But really nobody ever looks at your receipts again. To the point where as a CPA, all my receipts go into a box. They get logged. I keep up with my accounting. Then all my receipts go into a plastic box. I put the year on it and put it in a closet. I don't sort them in a certain order. I don't put them by date. I don't put them by vendor, because I never go back and look at them again. If I ever were to have an audit, am I going to have to spend some time sorting through receipts? Yeah, I will. But the time, it's kind of like a trade-off. The chances of being audited are so low, I'm not going to spend the time on the front end. It just kind of doesn't make sense to me. But now, if you're a super like type A person and you want to file all your receipts in a certain way, go for it. I mean, there's nothing stopping you. But the receipts are only if you're ever to be audited. And here's the other thing with receipts. Paper receipts, obviously, put them in the bank, or put them in your box. Garage sales, estate sales, keep a logbook, write it down. You need to have some documentation of what's happening, just in case that you ever do get audited. And then electronic receipts. In this day and age, most things are electronic. The IRS totally takes electronic receipts. That's not a problem. Credit cards and bank statements count as electronic receipts. However, if your credit card or bank statement is vague as to what that expense is for, it's to your benefit to jot down a little note. Let's say, hopefully you have separate accounts, and on your business account, you went to Publix and, I don't know, got some plastic sandwich bags because you use them to help sort the minis that you sell. Well, it's a charge to Publix. That's a grocery store. If nobody lives in the South, it's a Southern grocery store. If I were an IRS agent and I'm looking at this and I'm like, Publix, that's not a business place. What would you buy there? This way, if you jot down on that bank statement or that credit card statement that this was for sandwich bags I used to sort my minis, you'll be able to substantiate that claim. So anything that's out of the ordinary, anything that's unusual, that's not easy to explain, I would keep track of that. Where have you been? Oh, thank you. Feel free to ask any questions here, and also you can DM me at any time. So if you are ever to get audited, there's a couple different types of audits, and I didn't take notes on this, so I'm going off the top of my head, so kind of bear with me on this. There's different levels of audits. A lot of times it's just like a letter. They'll send you a letter. Hey, we got a question on this. Can you send us some documentation? So there's different levels. And then there's like a desk audit. And then there's like when the IRS agent comes and sees you. So there's different levels of audits. Most of them start with, hey, here's a letter. We got some questions for you. Can you just answer this? You answer the questions. You send them what they ask. Fine and good, said and done. It's over with. That most of the audits are like that. Most of it is the computer flagged something that looked odd. They just need now a person. It's got sent to a person. They need to verify. So don't get stressed about it. If you're doing what you're supposed to, I wouldn't really worry about it. And we always talk about, oh, we got to do this so we don't get audited. Even at the odds of you getting audited to begin with are probably fairly small. I mean, fairly small. It's not something that's happening to the majority of people. The IRS continues to cut staff. They continue, and the reselling market is growing. More people are entrepreneurs, and the IRS is cutting staff. They don't have enough people to do it all. Now, with the emergence of AI and computers are able to match things up quicker, faster, a little more reliably. So that may kind of offset some of that. But that was kind of a rabbit hole I went down. So if you guys have any other questions, please feel free to put them in there. Or like I said, I'm available by DM at any time if you just have a general question. I can't talk to specifics of your unique situation, but I can guide you into, hey, you can take a look at this, or this is kind of what the IRS says. So we can do stuff like that. What else can we talk about here? I made over $600 and never got, so it's not $600, it is $20,000 and 200 transactions to get a 1099 from Whatnot. It used to be 600. So this is one of those things you're going to hear different numbers thrown out. And this can be a very confusing topic on the 1099s because the IRS was at one point it was 600. Then they were trying to get a little bit higher and it was 5,000 for a short period of time. I don't think it was ever 2,000 and now it's 20,000. So it's gone up and down. And actually in the middle of 2025, they changed it from 5,000 to 20,000. It got changed smack dab in the middle of 2025 what the requirement was. So these numbers are all over the place. It kind of depends. This is what happens. This is real life. And I don't talk politics, and I'm not getting into politics. I'm just talking about the process here. Different political parties, they want this bill passed or that bill passed. And what happens is they'll put in something about a tax savings or a deduction in these weird bills. And one of them will get passed. And then all of a sudden something changes in June or September during the year. That's how the IRS works. This is why if you're going to do it yourself, if you're doing your own taxes, which I think most people are capable of doing, make sure that you pull up the most recent instructions and you're kind of looking through the instructions on the Schedule C and the 1040 as you go through, because anything that's changed will be in those new instructions. Or if you're using any type of software, they have all of that built in already. They take that stuff into consideration. And then, of course, if you go to somebody, they go to classes and they sit through educational seminars to learn all the new stuff. I'm sorry, what was that? I can't hear you. Yes. So that's the other thing too. When we're talking about 1099s, even if you didn't hit the threshold, even if you didn't get the 1099, you still have to report your income. It's still reportable. That 1099 threshold is only for what? Not for having to send you the 1099. Has zero to do with you reporting it. You still have to report your 1099 or all your income regardless. I was looking on Stripe. Oh, you were, okay, good. So the 600 too, this is another part of that 1099 confusion is, hello, how are you tonight? There are different types of 1099s. So we get a 1099K. That's what comes to us as a reseller, as a gig economy worker. We get a 1099K. There's also what's called a 1099G. That's gambling income. Same concept, but it's only people if you win gambling earnings. There's also a 1099 NEC, which is non-employee compensation. And each one of those 1099s has different thresholds. And this is why I say when you're hearing people talk about it, you're going to hear different numbers because it's very easy to get them mixed up with each other. Thank you so much. We are doing good. I had an interesting conversation that I'll talk about. So the best way to double check against your books is from Whatnot monthly statements. If it's less than 20, absolutely. Yep, that's what I would do. I actually would use the annual statement. I use the monthly statements every month as part of my accounting process. But then at the end of the year, I pull the annual statement from Whatnot, add everything up and make sure that it all matches to the annual statement. And as long as you're doing what you should be and keeping up with it, throughout the year, the end of the year should be pretty easy because you're doing the hard work on a day-to-day basis. So one of the things I wanted to talk about, and I'm not going to name any names, but I had a very interesting conversation. Somebody reached out to me and they are selling some product for a family member. And they're like, well, hey, how do I transfer this money to my family member? Because it's not my income. When we go into reselling, taxes and accounting are usually not on the forefront of anybody's mind when you start reselling. What's on most people's minds when they start is, where am I going to get the product? Getting over your nerves of going live. How does this app work? So it's all the logistical things of actually selling. That's what's on the forefront of our minds. However, everything we do has some type of bookkeeping and tax implication ultimately. So as you're just starting out, you really want to kind of think through some of these scenarios. And again, your first year is a perfect time to, oh, I got to sneeze. Hold on. Okay, hopefully that's it. 3 in a row. Okay. So when you're starting out is the perfect time to meet with the tax, thank you so much, to meet with the tax professional and really talk through these situations, because it can seem something as simple as selling some product for a family member could be like, oh, cousin Joe just asked me to sell his collection of sports cards. And it just seems like nothing, right? It just seems like, sure, Joe, I'll help you out. I got a Whatnot show. Let me go ahead and sell those. but all of a sudden you sell those cards and that income is your income to report. And you come at the end of the year and you're like, but wait a minute, that's not my money. I gave the money to Joe. Like, Joe needs to report that money. Well, yes, Joe does need to report that money, but Whatnot doesn't know that. The IRS doesn't know that. So now you have some hoops you have to jump through. Now you need to issue Joe a 1099 that he has to report on his tax return in order for you to deduct it from your tax return. And Joe's over there sitting like, dude, I didn't know I was going to have to report this. Why are you giving me this form? And now you're filing 1099s. Joe's upset at you. So there's a lot that goes into it, even with simple situations, such as selling something for a family member. Now, if grandma just gives you a vase and she's like, here, I don't need this, sell it, it's not a big deal. But I've heard from sellers and talked to people in the past that like they're actually making significant sales on behalf of somebody else. That could pose problems. I'm trying to think of other scenarios. Here's another scenario.
Not only that, in certain states, you're considered to be an auctioneer. And in order to be able to do consignments, you have to have a license with the state to be able to consign those items and sell them. So you could be liable for that too.
Yeah, the co-signing laws are almost more strict than some of the auctioneer laws. So that's something you definitely, before you're co-signing, you want to just make sure, like with anything, you understand the rules and regulations of the locality that you live in. That's just a normal part of doing a business. No matter what business you're in, you need to know what laws apply to you for that business. Another scenario that a lot of people don't think of when they go into Whatnot or into some type of live selling, reselling, is maybe, mom and daughter want to join teams. Daughter's married, has her family, mom's over here retired. They're like, we both love to thrift. We love to antique. Let's join up. We'll do a show together. We get to source together. This is going to be wonderful. But whose name is on that Whatnot account? Whoever's name is on that Whatnot account has to report all that income. So if daughter's name's on that Whatnot account, guess what? Every single cent of that gross income is coming to her. It's going on her tax return. So this is a scenario where we start to think of, wow, in order to separate out this income, in order for mom to pay her portion and daughter to pay her portion, maybe it's time to look at an LLC or some type of corporation, some type of legal entity, so that we can now legally separate out this money. So some of the scenarios, particularly when you're starting, seem benign and just simple and like, oh, this is just common, can really have some huge implications down the road. So definitely, try to get some type of consultation. And I say this, I think, every single show. H&R Block sometimes gets a bad rap, but they have a whole business section of H&R Block that is open year round, not just at tax time. They're open year round, and they have CPAs that work there to consult and help business owners. So is it the big Nike corporations and stuff like that going to H&R Block? No, it's us. It's the entrepreneurs, it's the sole proprietors, it's the smaller LLCs, it's the smaller S corps. These are the ones that are going and using those services, because the big guys are using the top 4 accounting firms and global accounting firms. So this is a good place to get good education, good knowledge for a very reasonable price over some of the CPA firms. And I say that as a CPA, that there's other alternatives to than paying $400 to $600 an hour for a CPA, and you can still get the same benefit in return. Now, as I say that, I really do believe that if you use a tax act, a TurboTax, whatever, all the software that's out there, they're all pretty much built the same. They all operate off of the same IRS regulations. Some may be more user-friendly, some may have some more bells and whistles, but at the end of the day, they all run off the same general premise. So I don't have a favorite out of those. Most of them are built for you to do your own taxes and answer each question honestly. And if you don't understand the question, go ahead and click the help and see, what does this say? What are they telling me about this? And then if you still don't understand, because sometimes it can be confusing. And like I said, there's a lot of gray in IRS, right? If you still don't understand, go to irs.gov, www.irs.gov, and pull up the Schedule C instructions. And you can be like, oh, now I get it. Now there's enough information. I firmly believe that most people are capable of using this software and doing their own taxes. I strongly suggest that in your very first year, you at least meet with somebody to talk through them. All right, that's a whole lot of words. We've been on for about an hour. Usually I like to keep these to an hour because tax is a pretty heavy topic to talk about for a long time. But do you guys have any other questions before we find somebody to rate? So if I don't see questions, we're going to go raid. So before I close, just remember the home office deductions, what we talked about today, it is highly beneficial. There's two methods. You could take the one that gives you the best tax advantage, so that reduces your income the most. This is a very powerful way to drive your taxable income down. That's what we want to do. Legally, we are allowed to look at all these other ways to drive my taxable income down. So this is a really good way to help save you on your taxes. With that, I think we're going to go raid. Feel free to always message me if you guys have questions. And I will be doing these shows every Friday night through April 15th, just as we gear up and get closer to tax day. And if not this show, I also do Friday mornings. I do business and tax talk. Those are more, I already have a 52-week schedule, so I already have a schedule of what I talk about, but you can always come and ask questions there too. So thank you all for hanging out. I really appreciate it. I hope you guys have a great weekend. If you like vintage decor, I am doing a vintage decor show tomorrow at 4 o'clock. All right, we're going to go raid.